Hello and welcome to AI Market News by LM. Before we jump in, a quick disclaimer. This video's audio is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion. Okay, so let's get right into it. The big news today, October 1st, 2025. The US government is officially shut down. The new fiscal year is here, but with no funding agreement from Congress, Washington, D.C. has pretty much ground to a halt. And believe me, the shockwaves are already being felt across the globe. So what happened and what does it mean for all of us? Let's break it down.
So what exactly went down? Well, in a nutshell, Congress just could not pass a funding bill before the deadline. This has triggered the first U.S. government shutdown in almost 7 years, and it's actually the third one under President Donald Trump. It really just signals a deep, ongoing political deadlock.
And the immediate human cost is, well, it's staggering. We're looking at an estimated 750,000 federal workers being furloughed. What does that mean? It means they've been sent home, temporarily, without any pay. So this isn't just some political headline, it's a direct hit to hundreds of thousands of families, and it's definitely going to have a very real impact on things like consumer spending and confidence.
Now, the big sticking point seems to be a fierce debate over healthcare subsidies. But what's really got people's nerves on edge is this extra layer of economic uncertainty coming from the White House. President Trump actually suggested this shutdown could be an opportunity for mass layoffs, saying that many good things could come from it. You know, that kind of language really changes the game. It takes this from a temporary political fight to a potentially pretty severe economic event.
As we'd all expect, this kind of turmoil isn't just staying in Washington. It is sending immediate shockwaves right across global financial markets. So, what's the so what for investors? How is this all playing out? Right off the bat, we're seeing a sea of red in U.S. equity futures. Both the S&P 500 and the tech-heavy NASDAQ 100 are pointing to a lower open. And this pullback is pretty significant because it seriously threatens the strong rally we've seen so far this year, which, let's be honest, was already showing some signs of losing steam. This shutdown could be the very thing that turns a little slowdown into a real correction.
And this is not just the US story, not by a long shot. The negative feeling has gone global. Just look at the Japanese markets, which are often a great indicator for risk appetite in Asia. They closed sharply lower. The Topix was down 1.4% and the Nikkei lost 0.8%. This just goes to show that investor psychology has soured pretty much everywhere, with folks pulling back from risky assets. You know, this widespread risk-off mood, as we call it, can actually be measured. There are tools like the Fear and Greed Index, which are designed for exactly these kinds of moments. They gauge whether investors are being driven by fear or by greed. And right now, with investors pulling back from risk and rushing to safety, well, you can guess which one it is. The index is flashing clear signals of fear all across the board.
So beyond the immediate market jitters, the shutdown is creating a much more dangerous and potentially longer-lasting problem. A total blackout of official economic data. This might just be the most critical consequence for policymakers and investors. We're all basically flying without a map right now.
And here's the crucial point. Key agencies like the Bureau of Labor Statistics, they're closed. This leaves the Federal Reserve, and frankly all of us, completely in the dark. I mean, how can the Fed make these huge multi-billion-dollar policy decisions on interest rates when it has absolutely no official data on the health of the economy? It's a massive, massive problem.
And the scale of this issue is immense. We're talking about the delay of the most important economic reports there are. The September U.S. jobs report, that's the big one. Non-farm payrolls, which was scheduled for this Friday, is now on hold. Same story for critical inflation data, for GDP figures. That jobs number was supposed to be the key piece of the puzzle guiding the Fed's next move. Now, it's just a blank space.
So with all this uncertainty and no reliable data to go on, investors are doing what they always do in a crisis. They're running for cover. And this is creating some really significant moves in the currency and commodity markets as everybody rushes towards what they see as safety.
The dynamic playing out is a classic risk-off move. The US dollar is weakening quite a bit on concerns that the shutdown will actively hurt the US economy. So what happens? Money flows out of the dollar and into traditional safe haven currencies, causing the euro and the Japanese yen to strengthen. It is a clear vote of no confidence in the short-term outlook for the US.
And the move is pretty clear if we look at the numbers. The euro is climbing against the dollar, heading up towards 1.1732, while at the same time, the dollar is falling against the yen,
down into the low 147s. The yen's strength in particular is a textbook safe haven move. It's what global investors do when there's turmoil. They seek shelter in Japanese assets.
But maybe the biggest flight to safety we're seeing is in the commodity space. Gold prices have absolutely surged to a record high, breaking near $3,900 an ounce. In a world full of political uncertainty and data blackouts, investors are flocking to the ultimate safe haven asset, an asset that has no counterparty risk and has been a store of value for, well, millennia.
So all of this leads to the really critical question: how are central banks, especially the Federal Reserve, going to respond to this crisis? They are now being forced to make policy decisions in a complete information vacuum, which, let me tell you, is a nightmare scenario for any central banker.
To really get a handle on the Fed's dilemma, we can look at tools like the CME FedWatch tool. It basically tracks what the market thinks the Fed is going to do. See, the shutdown itself acts as a brake on the economy. It's like a self-inflicted wound. When we combine that economic drag with the total data blackout, the pressure on the Fed to lower interest rates to support the economy just goes way, way up.
And we're already seeing this shift in expectations. Some analysts are now suggesting that the Fed might be forced to discuss a larger interest rate cut at its next meeting, just to try and prop up confidence. The market is increasingly pricing in a more aggressive, more dovish response from the Fed as a direct result of all this chaos. Now, it's interesting to contrast the Fed's situation with its European counterparts. The European Central Bank, the ECB, is in a much more stable position. With Eurozone inflation coming in right around their target at 2.2%, there's very little pressure on them to do anything. Same story for the Bank of England. The chaos, for now, is a uniquely American problem.
Okay, so with all the official US data offline, what should we be watching? Well, all eyes are now turning to just a handful of private sector reports to get any kind of read on the economy.
If we look at the economic calendar on investing.com, 2 private sector reports this week have suddenly become mission critical. First up is the ADP non-farm employment report on Wednesday. This will now basically be treated as the main stand-in for the official government jobs number. Then, later that morning, we get the ISM manufacturing PMI, which is going to give us a vital read on the health of the manufacturing sector. These private data points are all we've got to go on.
Ultimately, how long this shutdown lasts is the key variable here. The last major one back in 2018-2019 lasted 35 days and caused something like $11 billion in economic damage, and $3 billion of that was just lost forever. So the longer this goes on, the more severe the economic impact will be. Which leads us with the final, crucial question. In a total data vacuum, is it going to be raw fear or the few remaining fundamentals that drives the market's next move? Thanks for watching. Don't forget to like and subscribe.